Welcome back to Morning Trade Live. I'm Oliver Rennick. We're here at the Schwab Impact Conference in Philadelphia. A lot of great minds. Let's get straight to it. Joining me, Lara Rhame is the Chief U.S. Economist at FS Investment Solutions. Lara, we've been talking together about the economy for a while. How surprising is it just how strong these numbers are we're expected to see the next 2 days from GDP in particular back above 4%?
Yeah, it could not be more surprising. This is going to go down as one of the most unique business cycles that we've seen because we know that there has been a lot of tailwinds and a lot of momentum, but to have a reacceleration this late in the business cycle with really no new fresh stimulus has been really extraordinary. So I expect GDP to come in north of 4%. That is over double what our sort of resting heart rate growth should be.
Wow.
And I think it's something that really sets up this continued sell-off in long-term rates. It keeps Fed rate hike expectations alive. It's going to be a really interesting week for data.
I love the way you put that, the perspective of the heart rate, right? Yeah. Because there's a difference between a soft landing and what I've called the trampoline landing, because we're actually getting the bounce, and that's a really important part of this. That's just not really in the cards when you include bear steepening, things that we just don't really know what to do with. How long can it last?
I think what you're asking is so critical because when we think about a recession or some kind of economic slowdown, when things are strong, we tend to push those expectations off. I actually think that rising long-term interest rates have made chances of a recession next year go up, not down. So that is the sort of irony of this strong growth moment that we're having. These long-term interest rates, these higher mortgage rates, higher investment rates are really going to mean that we're going to see growth and this credit squeeze continue. And I think it's going to be more painful now because growth is so strong today than it would have been otherwise.
So the drop off a little bit harder now that we actually have some good numbers behind us. What's the mechanism of those rates going up that put the squeeze on the economy? Because last year they went up really fast. They even crashed the stock market hard. And we technically, I guess part of it is, we changed the definition of recession a little bit. We technically did get a couple quarters that dropped off, but never that big negative impact. So what is the mechanism now? Does the stock market have to crash again, or is it just like time where it works its way through the system?
Yeah. I don't think it's a stock market crash by any stretch, but the challenges that we're seeing in the stock market today are indicative of both the bear steepening and the fact that when you have growth, when you have interest rates this high, it's really hard to project forward the earnings. And that is, to me, the discount rate really changes. The present value of those future earnings gets hit. So I think it's a grind. It's a margin squeeze, and all of this continues, especially, because we know that the banks are going to continue to come under pressure as long-term interest rates rise. It's why that public sector investment is so challenged, and you need to look to the private solutions that are going to benefit from this pretty traditional Fed channel of influence in the credit market.
That's important, the use of the word traditional there, that again, a lot of these things are just normalizing. Here's a chart that we grabbed from your report that basically, I think, puts this into the visual perspective, because the yield in the orange there, which is your yield on the 10-year, has surpassed, you're looking at what, the earnings yield?
Free cash flow yield.
Oh, free cash flow yield from the S&P?
Yeah, and I think this is exactly the point. And I think, when you see equities being challenged right now because long-term interest rates are high, is the stock market properly compensating you for the risk that you're taking?
Doesn't look like it, according to that.
Right. You're going to need tremendous growth on top of those yields to make that compensation calculation worthwhile. And that's where I've struggled to square the circle. The bond market, the yield curve's inverted. That is a risk of recession that market is flashing. On the equity side, you're seeing this expectation that we're going to reaccelerate and the growth is going to stay as strong as it is today all the way forward into next year. You just can't have both markets doing the same thing at the same time.
To me, it seems like stocks are more at risk in the short, near term than the economy itself then, because we got another chart looking at jobless claims, this reversal down after the big bounce up from late last year. Again, there seems to be this resilience that hasn't been cracked. what then do we look for to know if it's actually cracking? Because that inversion that you talked about that usually tells us, well, just wait, the recession's coming. We could uninvert any day now.
Yeah, I think
for the yield curve.
There have been a lot of false starts. And in the second quarter, I saw that same spike in initial claims and was, like, here we go. This is the recession that's starting. I think all of the reasons why we may have a mild recession, and that was my initial forecast for 2024, the labor hoarding, the infrastructure spending, all of these things may be why we do not, in fact, get a recession. We may just get some sluggish growth. But the idea that it could continue at plus 4% indefinitely is just not realistic. And if, to me, I think markets aren't taking seriously enough the idea that the Fed may raise rates again. So I think that still is very much on the table for the fourth quarter of early next year.
There's just no chance of a cut anytime soon. So if that's still priced into stocks, it's going to be a problem.
And it still is priced into stocks. I think the forward futures curve for the Fed, they're still looking at 50, 60 basis points of rate cuts. That's going to continue to come out of the market. The Fed is going to just wring that right out through all of their hawkish talk. I think that continues this sell-off in the long end of the yield curve.
So it basically keeps going until something really breaks in the economy. Powell and many others describe that move in the yield as kind of doing their job for them. What do you make of that?
I think that's right, because I think that's sort of the deal with the devil that Powell has made. Okay, we're not going to keep raising rates, but you're going to have to experience financial tightening in some form. And if it doesn't come from the Fed, it's going to come organically from somewhere else. And it makes sense. I mean, the data have been strong. The idea that markets were pricing in rate cuts when initial claims are below 200,000 is just, really doesn't make sense. So we needed those expectations to come out. And this is, we're coming off of 15 years of interest rates at zero.
Right.
It's going to take us time to get used to a new normal where I think we're not going to be higher for longer 2024. No, this is 25, maybe even 26.
That's a big point because there is an obsession by the market to constantly try and price in cuts just because of how things were the past decade. The fact that our solution to a virus was to cut rates. There's some stuff in there where it just seemed like whatever happens, we cut.
Yeah.
And so people keep seeking that out. But there is this argument, I guess, to be made that deal with the devil Powell makes might overwhelm him, because when you're coming off that zero bound, your math changes. You can't divide by zero. We don't know. The rates of change here are going to be, some would argue, overwhelming, that the Treasury will become a source of volatility because of all the bonds they have to issue. Does the bear case out there have to factor in like an economic Armageddon case that like the gold bugs and the coiners are whispering in our ear about?
I think 2024 is going to be a more challenging year for monetary policy than the last 2 years have been. Because, and to me, the challenge comes from the inflation side.
Okay.
I think inflation, the disinflationary process has become choppier. It's not a one-way move anymore. And I think 2024 is going to be a year where inflation is uncomfortably high. It doesn't give them really any room to cut. The data may start to deteriorate, but their room to maneuver is going to narrow a lot. And I think it's going to be one of the more challenging years for monetary policy.
And that in itself is kind of a new realm where they can't really cut, but then at a certain point, maybe they can't hike. It feels like that's kind of maybe where we're getting to. One last point here, Lara, which is about the combination of that growth and inflation, as you mentioned, inflation being the main concern. Is it possible we could get a beat on GDP and then a cool inflation print? Because that seems like the dream case. Is there an economic scenario where we could get the best of both worlds?
Of course, and that is the hope, right? That we avoid a recession. I think the reality is that growth that is this strong is just unsustainable. And so it's either going to slow by itself or the Fed is going to have to continue to push on that brake. And if I were them right now, I would not be taking my foot off that brake anytime soon. And I think they are just watching these jobs numbers, which are strong. Everything feels like it's reaccelerating. Again, so unique in this stage in the business cycle, and I think something that is going to make their job very challenging next year.
Another challenge perhaps is that the real deposit change by income cohort, we were just looking at one last chart, is that it's still kind of skewed. Is that a problem that it's skewed a little bit towards the upper end still, or is that just kind of how things work?
Oh, no, sure. I think that is going to continue to be an issue. And I think as we look ahead to the Fed and to traditional asset performance next year, we've had now multiple years where this bond stock correlation has broken down. When interest rates are above 4.5%, that doesn't work anymore. We're coming out again of a 15-year period where stocks and bonds diversified each other, and now we're heading into a period where they're positively correlated. It's very painful for building a portfolio with using only traditional assets.
Absolutely understood. All right, sounds like, again, another kind of tease there for alternative investments.
Absolutely.
Okay.
Yeah, the private markets, deeper in the capital stack, that's the way to create the ballast in your portfolio.
I'm being reminded of my conversation with Troy Gajewski this week about alternative private credit. Lara, great to catch up. Thanks a lot.
Thank you.
Appreciate your time. Lara Rhame, Chief U.S. Economist at FS Investment Solutions.